We are looking at what might be the single most contradictory setup in the entire stock market right now. It's June 30th, 2026, and the paradox surrounding Oracle is just massive. You've got a company sitting dead center of the AI boom, literally rewiring global enterprise tech. And yet, it's giving Wall Street serious whiplash. Just look at this. Over the last month, Oracle's stock has suffered a brutal 40% retracement from its recent highs, crashing all the way down into the 140s. Normally, a drop that steep means something broke. A catastrophic failure in the business, a sudden loss of market share, or an earnings miss so bad it shatters the whole investment thesis. But here's the catch. None of that happened. In fact, they just reported a massive fourth-quarter revenue beat for their cloud business, and it's being fueled by an AI order backlog that has absolutely exploded to a staggering $638 billion. Take a second and let that number sink in. So how on earth does a company lock down well over $500 billion in future AI business, only to watch its stock just fall right off a cliff? Uncovering the mechanics behind this exact kind of market contradiction is what we're all about. Because if you're fascinated by how next-gen tech, stuff like AI, cloud computing, and advanced robotics, is fundamentally rewiring financial markets, you really should make sure you're subscribed to Future Ready. We are constantly tracking the breakthrough companies actually building our future. To figure out how they capture that insane level of demand, we have to realize that the old Oracle, it's basically gone. The market used to look at them as this steady, highly profitable, but kind of slow-moving legacy database company. Not anymore. Today, they're operating on a completely different model. They have essentially become the AI infrastructure landlord. They aren't just selling digital licenses, they're literally pouring concrete, laying massive high-performance networking cables, and building the physical gigawatt-scale skyscrapers that the AI era requires. And you can see this transformation clearest in a metric called RPO, or Remaining Performance Obligations. Simply put, this is the company's order backlog. It's contracted money from customers that just hasn't been recognized as revenue on the income statement yet. Oracle's RPO just skyrocketed 363% year over year to hit that record $638 billion mark. And a huge chunk of that is driven by these massive multi-year AI data center contracts. We're talking about deals where customers are actually prepaying or even supplying their own GPUs just to secure physical space. Now, if we look at the current state of the global cloud market, the reality is pretty stark. As of 2026, Oracle holds just about 4% of the global pie. They are way behind the heavyweights. Amazon's at 28%, Microsoft's at 21%, Google's at 14%. But you have to look past that total market share, because here is the critical nuance. Oracle is deliberately stealing the most demanding, highest-end AI training workloads right out from under those exact giants. And honestly, the strategy is working incredibly fast. The ultimate validation here is their landmark $300 billion contract with OpenAI. When the creators of ChatGPT needed the computing backbone to train their next-generation models, they didn't go to the big three, they turned to Oracle. Plus, Oracle's multi-cloud AI database is seeing this explosive 404% year-over-year growth. By leveraging high-speed RDMA networking, which basically allows for ultra-fast, direct data transfers without clogging the network, Oracle isn't just competing with Microsoft, Google, and Amazon anymore. It's actually supplying them with core infrastructure. So the technology story, it is undeniably strong. But hiding right underneath that top-line revenue growth is a severe financial reality that has Wall Street slamming the panic button. This is the $95 billion catch. You see, physically building the infrastructure for the AI revolution is incredibly capital-intensive. Capital expenditures are absolutely skyrocketing. They are spending tens of billions of dollars a year on physical assets, new data centers, advanced servers, you name it. And as those capital expenditures soar, their free cash flow is severely deteriorating, just plunging deep into the red. And this brilliantly illustrates just how severe that hidden cost really is. Looking at the fiscal year, free cash flow hit a deeply negative $23.7 billion. They're burning through cash at a truly historic rate just to fund this aggressive AI data center expansion. These hidden costs are compounding fast. Oracle's projected capital spending for fiscal 2027 is scaling up to an unbelievable $95 billion. To actually afford that, they just filed to authorize a new $20 billion at-the-market equity distribution program, which means massive potential shareholder dilution. On top of that, they plan to raise a total of $40 billion through debt and equity, piling onto a debt burden that's already north of $130 billion. And operationally, They just had to cut 21,000 jobs. That is 13% of their global workforce, triggering nearly $2 billion in restructuring costs alone. Getting past the hype to uncover hidden financial realities like this is exactly why we created Future Ready. So if you appreciate objective analysis of the tech shaping our markets, hit subscribe and join us. Which brings us right to the ultimate bull versus bear debate. We have to separate the fundamental quality of Oracle's technology from the very harsh reality of their balance sheet. The bulls are looking at explosive Oracle Cloud infrastructure growth, up 47% in Q4. They see incredibly sticky enterprise AI demand, and of course, that unmatched $638 billion contracted backlog. But the bears? They are laser-focused on that deep negative $23.7 billion in free cash flow, the massive shareholder dilution risk from new stock offerings, and a rising debt burden that leaves almost zero room for error if AI demand suddenly cools off. And the bears are definitely putting their money where their mouths are. By mid-June 2026, short interest in Oracle jumped over 8% to a massive 37.68 million shares sold short. That's a huge spike in traders actively betting the stock price will drop, and it really highlights Wall Street's growing anxiety over this near-term cash burn and extreme financial leverage. But for swing traders trying to navigate this 40% drop, this fundamental tension actually creates a fascinating technical setup. Right now, Oracle's stock has fallen directly into a major historical support zone, sitting right between $141.10 and $155.96. Historically, this specific level has been a massive magnet for buying interest. In fact, since the stock first traded up into this range, it has bounced off this exact support level 4 different times. And we aren't talking about small bounces. We're looking at an average peak return of over 59% following tests of this support, including a massive 122% run that kicked off back in May of 2025. Purely from a technical perspective, this is a historic entry point. But as we know, a technical setup always needs a catalyst to actually drive it. We just got through the June 2026 Q4 earnings and CapEx reveal, which was the fundamental event that sparked all this current volatility. Looking ahead, the next major midterm catalyst is the Oracle AI World 2026 event coming up in October. That conference is going to be critical. Management has to unveil their new agentic and automation tools, and much more importantly, they need to convince investors that this massive infrastructure bet is actually translating into high-margin revenue faster than they're burning the cash. So, the crucial takeaway here is that we have to completely separate Oracle's undeniable long-term technological dominance from its very real short-term valuation risks. Over a multi-year horizon, Oracle's secular AI infrastructure growth firmly positions them as a foundational pillar of this next technological era. But right now, in the short term, those extreme capital expenditures and that aggressive $20 billion share dilution program are putting a very heavy ceiling on the stock. Which leads us to the final verdict for swing traders. Yes, the current support level offers a historically attractive technical entry, no doubt about it. However, the sheer size of that impending $20 billion equity dilution fundamentally caps any immediate explosive upside. The most logical strategy right now is to either wait for definitive price stabilization before entering or to trade very small sizes so you can weather the ongoing volatility. The base case for the rest of 2026 is a balanced but very choppy mix of growth and heavy financial maneuvering. Before we wrap up, if you want to stay ahead of market dynamics exactly like this and continuously track the breakthrough companies shaping the future, make sure you subscribe to Future Ready right now. This company clearly has the technology, they've got the contracts, and they have the vision. But the ultimate question remains, will Oracle's massive infrastructure bet actually pay off before the debt catches up?